90% of traders fail not because they're stupid but because they lack brutal discipline. The market doesn't reward hope, emotions, or revenge trades. It rewards control. Elite traders follow rules so strict they feel uncomfortable. And that discomfort, that's where the money is made. Today you'll discover the discipline edge that changes everything. The market is neutral. It doesn't care how intelligent you are. It doesn't respect how hard you work. It doesn't reward how badly you need the money. It doesn't know your struggles, your goals, or your dreams. It simply moves. And in that movement, it exposes one thing: your level of emotional control. Many traders believe success will come from learning more strategies, adding more indicators, or watching more charts. They think effort equals reward. But trading is not a school exam. The smartest person doesn't automatically win. The hardest worker doesn't automatically profit. The market does not reward intelligence. It does not reward effort. It rewards consistency and emotional stability. You can understand technical analysis perfectly and still lose money because knowledge is useless without discipline. You can spend years studying price action and still fail because the real battle is not against the chart, it is against yourself. Trading is not an intellectual competition, it is a behavioral one. Elite traders understand something amateurs don't. Trading is not gambling, it is not excitement, it is not fast money, it is a controlled operation. They treat trading like a military mission, not a casino visit. A soldier does not enter a battlefield hoping to get lucky. He enters with structure, planning, risk control, and strict rules. He knows when to move and when to wait. He knows when to engage and when to stand down. Elite traders operate the same way. They do not sit at the chart asking, "How much can I make today?" They ask, "Will I execute my system perfectly today?" That shift in focus separates professionals from dreamers. The amateur opens a trade because it feels right. The elite opens a trade because it meets predefined criteria. The amateur feels excitement before clicking buy or sell. The elite feels calm because the decision was already made by rules, not emotion. Discipline does not begin with rules. It begins with identity. If you still see yourself as someone trying to make quick money, your actions will reveal it. You will rush entries. You will chase moves. You will increase risk when you feel behind. But when you see yourself as a risk manager, everything changes. Amateur traders trade from emotion. Elite traders trade from rules. Amateurs look for excitement. Elites look for probability. Amateurs revenge trade after losses. Elites accept losses instantly. Amateurs overtrade because they feel they must always be in the market. Elites wait patiently because they know no position is also a position. Amateurs focus on money. Elites focus on execution. This is not just a small mindset adjustment, it is a complete identity transformation. The amateur wants to win trades. The elite wants to follow the process. The amateur measures success by today's profit. The elite measures success by how well rules were followed. Elite traders do not try to win trades. That sentence may sound strange, but it is powerful. They understand that any single trade is random. Even the best setup can lose. So instead of trying to control outcomes, they control behavior. They try to follow their process perfectly. They try to execute with precision. They try to manage risk consistently. And when that process is repeated over time, profits follow naturally. Profits are not chased. They are earned through repetition. If you chase money directly, you interfere with your system. You move stop losses. You cut winners early. You double risk after losses. You force trades that are not there. But when you focus only on execution, you remove emotional pressure. You detach from outcomes and attach to discipline. Emotional detachment is one of the strongest traits of elite traders. They accept losses as business expenses. Just like a company pays rent, salaries, and operational costs, a trader pays losses. It is part of the structure. There is no drama. There is no panic. There is no personal attack. A loss does not mean they are stupid. It does not mean the strategy is broken. It simply means that this trade did not work. They never increase risk to make it back. That is the behavior of someone emotional, not professional. They understand that trying to recover quickly usually creates deeper damage. They never move their stop loss emotionally. The stop loss was placed for a reason, based on structure and risk management. Moving it because of fear destroys discipline. They never chase missed trades. If they miss an entry, they let it go. The market will create another opportunity. Chasing creates bad positioning and emotional frustration. Discipline is doing the right thing when it feels wrong. It feels wrong to close a losing trade quickly. It feels wrong to sit out when the market is moving fast. It feels wrong to accept a small controlled loss. It feels wrong to wait patiently while others post profits. But that discomfort is the price of professionalism. Most traders break rules because they feel fear of losing, fear of missing out, fear of being wrong. They feel greed when a trade goes into profit and they want more than their target. They feel FOMO when price moves without them. They feel anger after losses. They feel frustration during drawdowns. Emotions are natural. Even elite traders feel them. The difference is not that professionals have no emotions. The difference is that they do not obey them. They allow the feeling to exist without allowing it to control action. An elite trader can feel fear and still respect the stop loss. He can feel greed and still take profit at the planned level. He can feel anger and still reduce position size instead of increasing it. He can feel FOMO and still wait for the next valid setup. That is emotional mastery. That is discipline. That is what separates those who survive from those who disappear. The market is neutral, but your behavior is not. If you approach trading like entertainment, it will cost you. If you approach it like a structured operation, it can reward you. The transformation begins the moment you stop asking, "How much can I make?" and start asking, "How perfectly can I execute?" When identity shifts from gambler to operator, from emotional to structured, from outcome, focused to process, focused, discipline stops being forced and starts becoming natural. And when discipline becomes natural, consistency becomes possible. Most traders enter the market thinking about profit. They open their chart and immediately ask, "How much can I make from this move?" That question feels natural, it feels ambitious, it feels motivating. But it is the wrong starting point. Elite traders think differently. Before they ever consider potential reward, they ask a more important question: how much can I lose? That single shift in focus changes everything. Because survival comes before growth. Protection comes before expansion. If you don't control downside, upside will never matter. The market can give endless opportunities, but it only takes one moment of reckless risk to erase months of effort. Elite traders are obsessed with risk, not because they are fearful, but because they understand mathematics. They know that every trade has uncertainty. No setup is guaranteed. No pattern is perfect. So instead of trying to predict outcomes with ego, they control what they can control. Position size, they risk a fixed percentage per trade, often 1% or less, not 5-10%, not whatever feels right. Fixed, pre-calculated. Structured, if their account is $10, they risk 100. If it grows to 12,000, if it drops to $9, they risk a $90. The risk adjusts with the account, but the percentage discipline remains untouched. This keeps them stable during both winning streaks and losing streaks. They never increase risk after a loss to recover faster. That behavior belongs to emotional traders. The moment you increase risk because you feel behind, you are no longer trading a system, you are trading your frustration. Elite traders understand that losses are part of probability. If the system says risk 1%, then it is 1% whether the last trade was a win or a loss. There is no doubling down emotionally. No sudden lot size jump because this one looks strong. The strength of a setup does not change the laws of uncertainty. Even perfect setups fail. Discipline means respecting that reality. There is a powerful truth many traders avoid: you don't blow accounts because of bad strategy. You blow accounts because of poor risk discipline. A mediocre strategy with strict risk control can survive. A great strategy with reckless risk will collapse. Account destruction rarely happens from one small, controlled loss. It happens from oversized positions, revenge trades, and emotional doubling. One trade at 10% risk can undo 10 disciplined trades at 1%. That is not a strategy problem. That is a risk management failure. Professionals treat risk like oxygen. They protect it at all costs. They understand that as long as capital is preserved, opportunity remains. But once capital is destroyed, the game is over. This is why they build fixed rules that are non-negotiable, not flexible, not adjustable based on mood, non-negotiable. They define a maximum daily loss limit, maybe 2% or 3%. Once that number is hit, trading stops for the day. No own more trade. No I'll recover before closing. No exceptions. Because they know that emotional intensity increases after losses, and emotional intensity leads to irrational decisions. They also define a maximum number of trades per day. Overtrading is silent account damage. When traders are bored, they force setups. When they are excited, they chase momentum. When they are frustrated, they click impulsively. Limiting the number of trades forces selectivity. It forces patience. It protects mental energy. Elite traders understand that quality beats quantity. 2 high-quality trades are better than 10 emotional ones. Every trade they take has a pre-defined stop loss. Not a mental stop. Not a, "I'll close it if it looks bad." A real, calculated level placed in the system. That stop loss is determined before the trade is entered, based on structure and logic, not fear. And once placed, it is not moved further away to avoid being hit. Moving a stop loss emotionally is one of the clearest signs of undisciplined trading. It transforms a planned risk into an uncontrolled one. Elite traders accept that if the stop is hit, the trade idea was invalid. They exit without drama. They also pre-define take-profit levels or exit strategies. They do not randomly close trades because they feel price might reverse. They do not hold trades endlessly because greed whispers that more is possible. The exit is part of the plan, just like the entry. Structure removes emotional noise. Rules remove hesitation. When the daily loss limit is reached, they shut down the platform. That simple action separates professionals from gamblers. Gamblers believe the next spin will fix everything. Professionals understand that stepping away protects clarity. Losing streaks are another area where risk discipline proves its power. Many traders secretly believe that once they become good, losses will disappear. That belief is dangerous. Even elite traders lose. Even strong systems experience drawdowns. The difference is that professionals expect losing streaks. They study probability deeply enough to understand variance. A system with a 50% win rate does not alternate win-loss in a perfect sequence. It can easily produce 5, 6, even 7 consecutive losses. That does not mean the system is broken. It means randomness is playing out. Undisciplined traders experience 3 losses in a row and panic. They start questioning everything. They change strategy mid-week. They adjust indicators. They remove stop losses. They increase risk to recover faster. They jump into new systems they saw online. Their actions are driven by discomfort, not logic. And in trying to escape short-term pain, they create long-term instability. Elite traders respond differently. When losses occur, they review execution, not emotion. Did I follow my rules? Did the setup meet criteria? Was risk correct? If the answer is yes, they continue. They trust probability. They understand that edge plays out over a large sample size, not a handful of trades. They measure performance over 50 trades, 100 trades, not over 1 week. They know that consistency across time creates statistical advantage. Breaking rules during drawdown destroys that advantage. This psychological preparation is crucial. If you expect only wins, losses will shock you. If you understand that losses are mathematically inevitable, they lose emotional power. Elite traders normalize drawdowns. They see them as phases, not failures. Because their risk per trade is small and fixed, even multiple losses do not create catastrophic damage. 5 consecutive 1% losses equal 5%, painful, but manageable, recoverable. But 5 consecutive 5% losses equal 25%. That creates pressure. That pressure fuels mistakes. That is why small risk is powerful. It protects mental stability. Risk management is not just about protecting money. It is about protecting psychology. Large risk magnifies emotion. Small controlled risk keeps the mind clear. When risk is controlled, decision-making improves. When decision-making improves, execution becomes consistent. When execution becomes consistent, results stabilize over time. Everything begins with risk. Professionals know they cannot control market direction. They cannot control news. They cannot control volatility spikes. But they can control exposure. They can control how much they are willing to lose. That control creates confidence, not the fake confidence of prediction, but the real confidence of structure. They enter trades knowing the worst-case scenario is already defined and acceptable. This is the code. Risk first, profit second, fixed percentage, no emotional doubling, non-negotiable daily limits, pre-defined exits. Expect losing streaks, trust probability, continue execution. The trader who masters this does not eliminate losses, he neutralizes their damage. And in doing so, he builds the foundation that allows consistency to exist in an environment where uncertainty never disappears. Execution is where most traders collapse, not because they don't understand the market, but because they don't respect structure. Knowledge without structure becomes impulse, and impulse in trading is expensive. Elite traders operate differently because they treat their trading plan as law, not as a suggestion, not as a flexible idea. Law, written, defined, clear. Before they ever risk money, they define exactly what conditions must exist for them to participate in the market. They specify which market environments they trade, trending, ranging, high volatility, specific sessions. They outline their exact setup rules so there is no confusion in the moment. They define entry criteria with precision. They determine exit criteria in advance. They lock in their risk management rules. They decide which hours they trade and which hours they avoid. They create rules around high-impact news. Everything is structured before emotions enter the room. Because once the chart is moving, emotions become louder than logic. If there is no written framework, decisions become reactions. No plan equals emotional trading. It is that simple. Without a defined structure, every candle feels like an opportunity. Every move feels personal. Every loss feels like a mistake that must be corrected immediately. Elite traders eliminate that chaos by pre-deciding their behavior. They do not feel trades. They do not rely on intuition during live execution. They rely on checklists. The plan decides, not their mood, not their confidence level, not what happened in the last trade. The power of a written plan is clarity under pressure. When price is moving fast, the brain looks for shortcuts. It wants to act quickly. It wants certainty. But the market never gives certainty. So elite traders create mechanical structure to protect themselves from their own impulses. They approach trading like a pilot preparing for takeoff. Pilots do not rely on memory when lives are at stake. They use checklists every single time, even if they have flown for 20 years. Not because they lack skill, but because they respect risk. Trading is no different. Skill does not remove the need for structure. In fact, the more serious you are, the more structured you become. Before entering any trade, elite traders mentally or physically go through confirmation points. Is the setup valid according to my written rules? Not does it look good, but does it match my criteria exactly? Is the risk acceptable within my predefined percentage? Is the position size calculated correctly based on stop-loss distance? Is the reward to risk ratio aligned with my minimum requirement? Is this trade being taken during my approved trading hours? Is there major news approaching that violates my rules? Is this truly within my plan? If even one condition fails, there is no trade, no negotiation, no emotional justification, no bending the rules because it might work. Most traders skip this process. They see movement and jump in. They calculate position size roughly. They assume the setup is close enough. They ignore reward to risk because they don't want to miss the move. They trade outside their optimal hours. They convince themselves that small rule breaks don't matter. But small rule breaks compound into inconsistent performance. Inconsistency creates emotional instability. Emotional instability destroys accounts. Elite traders never skip the checklist because they understand something critical: discipline is easier before entry than after entry. Once money is at risk, psychology changes. Fear and greed activate. Objectivity decreases. So the filtering process must happen before exposure. If the trade does not pass inspection beforehand, it does not deserve capital. This mindset transforms trading from reactive clicking into controlled execution. Patience then becomes a weapon, not a weakness, not something forced, a strategic advantage. Elite traders are comfortable waiting. Sometimes for hours, sometimes for days. They can watch the market move without them and remain calm. They do not interpret missed moves as lost identity. They understand that opportunities are not constant. High-quality setups are rare, and that rarity is what gives them value. If good trades appeared every 5 minutes, there would be no edge. The amateur wants action. Action feels productive. Sitting still feels like missing out. The amateur equates activity with progress. The elite understands that unnecessary activity is risk exposure without edge. Overtrading kills accounts quietly, not always through one massive loss, but through dozens of small, low-quality trades taken out of boredom or impatience. Each unnecessary trade slightly tilts probability against the trader. Over time, that tilt becomes damage. Patience is uncomfortable because the human brain craves stimulation, especially in trading, where charts are constantly moving. Every candle looks like something is happening. Every breakout looks tempting, but not every movement is your opportunity. Elite traders specialize in saying no. No to marginal setups, no to revenge entries, no to boredom trades, no to emotional impulses. Their profitability often comes more from the trades they avoid than the trades they take. This is where discipline truly lives, inside discomfort. It is uncomfortable to wait while others post profits. It is uncomfortable to close the platform after reaching your daily loss limit. It is uncomfortable to skip a setup that almost meets criteria, but not fully. It is uncomfortable to follow a checklist when your intuition is screaming to act. But that discomfort is the barrier between amateur behavior and professional execution. Precision requires restraint. Restraint requires clarity. Clarity requires a written plan. And a written plan only works when treated as law. Elite traders do not wake up and decide how they feel about the market. They already decided their behavior before the session began. The market's job is to present conditions. The trader's job is to respond only if those conditions match the plan, nothing more. Execution mindset is about separating decision from emotion. The decision is made by rules. The execution is simply carrying it out. There is no internal debate, no bargaining. No, just this once. The more mechanical the process becomes, the more stable the results become. Freedom in trading does not come from doing whatever you want. It comes from restricting yourself to what works. When patience combines with structure, trading slows down mentally. Even if the market is volatile, the trader remains steady. He is not chasing candles. He is waiting for alignment. He is not reacting to noise. He is executing a model. This shift turns trading from emotional guessing into strategic filtering. Most traders think success comes from finding more trades. In reality, it comes from filtering better trades. And filtering requires discipline strong enough to sit in silence while the market moves without you. Emotional mastery is the invisible system behind every consistently profitable trader. Most people try to control the market. Elite traders control themselves. Because fear and greed will always exist, they are wired into human psychology. The difference between failure and consistency is not the absence of emotion, it is the management of it. Fear and greed are the two forces that quietly sabotage performance. Fear shows up in subtle ways. It causes early exits when a trade is still valid. It creates hesitation right before entry, even when the setup meets every rule. It makes traders reduce position size randomly because they don't feel confident. It leads to missed trades that later hit full target, reinforcing frustration and self-doubt. Fear whispers, "What if this one loses?" And under that pressure, traders abandon their edge. Greed operates differently but is equally destructive. Greed convinces traders to remove stop losses because they are sure price will come back. It encourages oversized positions because the setup looks perfect. It tempts traders to hold positions far beyond planned targets, chasing extra profit until the market reverses. Greed whispers, "This is the big one." And in chasing more, traders often lose what they already had. Fear cuts winners short. Greed lets losers run. Together, they distort decision-making and break consistency. Elite traders do not eliminate fear and greed, they neutralize their influence. They do this by designing systems that reduce decision-making under pressure. They predefine exits before entering a trade. Stop loss and take profit levels are decided in calm conditions, not in emotional intensity. Once the trade is live, there is nothing to debate. The outcome is allowed to unfold. Many elite traders automate their stop loss immediately upon entry. There is no "I'll place it later." It is instant, mechanical, protected. They use fixed risk rules so that no single trade can emotionally destabilize them. When risk is small and predefined, fear decreases because the potential damage is controlled. When profit targets are structured, greed decreases because there is clarity. Structure removes emotional negotiation. The key principle is simple: the fewer decisions you make under pressure, the more stable your performance becomes. Emotional spikes happen during live trades. Heart rate increases. Focus narrows. Rational thinking weakens. That is not the moment to improvise. That is the moment to rely on what was decided earlier. Elite traders understand that discipline is built before the trade, not during it. When everything is predefined, entry criteria, stop placement, position size, exit logic, emotions lose authority. The trader becomes an executor, not a reactor. But emotional mastery does not stop at execution. It extends beyond the trade itself. One of the most powerful habits elite traders develop is the post-trade review ritual. They journal every trade, not occasionally, not only losing trades, every trade. They take screenshots of entries and exits. They record the exact reason for entry according to their plan. They document their emotional state before, during, and after the trade. Were they calm, hesitant, overconfident, frustrated? They write down mistakes made, even small ones. They extract lessons learned. This process builds awareness. Awareness is powerful because you cannot correct what you do not see. Many traders repeat the same mistakes for years because they never slow down to analyze patterns in their behavior. They remember big wins, they emotionally remember painful losses, but they do not track behavioral data. Journaling turns subjective memory into objective evidence. Over time, patterns appear. Maybe most losses come from trades taken outside defined hours. Maybe impulsive entries happen after 2 consecutive losses. Maybe greed appears after a strong winning streak. When these patterns become visible, they can be corrected. Awareness builds discipline. When you clearly see that overtrading costs you 3% per week, it becomes harder to justify. When you see that every revenge trade violated your plan, denial disappears. Review creates accountability, and without review, improvement is random. Trading without journaling is like trying to improve at a sport without watching replays. You may practice daily, but you will not refine weaknesses precisely. Elite traders treat journaling as seriously as execution, because execution generates results, but review refines performance. Emotional maturity is tested most on losing days. Anyone can feel confident on a winning day. Anyone can follow rules when everything is working. The real measure of discipline appears when the screen is red, when 2 trades hit stop loss, when the market behaves unpredictably, when confidence begins to shake. On red days, elite traders follow structure even more strictly. If the maximum daily loss is reached, they stop trading immediately, not because they are afraid, but because they respect emotional escalation. They understand that decision quality declines after consecutive losses, so they protect capital first. After stopping, they review, calmly, objectively. Did I follow my plan? Were these valid setups? Was risk correct? If rules were followed, they accept the day as statistically normal. If mistakes were made, they document them and adjust behavior, not the entire strategy. Then they step away. They reset mentally. They do not try to win the day back because they think long term. Amateurs react differently. A red day feels like a personal attack. They revenge trade. They double risk to recover losses quickly. They break daily limits because stopping feels like defeat. They tell themselves they just need one good trade to end positive. But in trying to fix the day, they often damage the week. Short-term emotional thinking overrides long-term consistency. Elite traders measure performance in months and quarters, not in single sessions. They understand that some days are statistically negative. That is part of probability. Their goal is not to win every day. Their goal is to execute correctly every day. If execution is consistent, profitability follows over time. If execution breaks during emotional stress, long-term results collapse. Emotional mastery is not about suppressing feelings. It is about designing systems that protect you from acting on unstable emotions. Predefined exits control greed. Fixed risk controls fear. Journaling builds awareness. Daily limits protect capital. Structured reviews build growth. Long-term thinking prevents desperation. All of this forms a system, not a motivational idea, but a practical framework. In the end, trading performance reflects emotional structure. The market will continue to fluctuate. Wins and losses will alternate unpredictably. Volatility will expand and contract. None of that changes. What changes is how the trader responds. When fear appears, the plan remains. When greed whispers, the checklist answers. When losses come, risk stays fixed. When red days happen, discipline holds. Emotional mastery is not visible on the chart, but it is visible in the equity curve of those who survive long enough to let probability reward consistency. Elite discipline is not something you are born with. It is something you build layer by layer, rule by rule, decision by decision. Most traders wait to feel ready before becoming disciplined. That feeling never comes. Discipline is created through structure, not motivation. If you want elite-level consistency, you must build your own rule book and treat it like law. Step 1 is defining your maximum risk per trade. Decide the exact percentage you are willing to lose on a single idea. For most serious traders, that number is 1% or less, not sometimes, not depending on confidence. Fixed step 2 is defining your daily loss limit. At what point does trading stop for the day? 2 cent, 3%. Choose the number in advance. When it's hit, the platform closes. No exceptions. Step 3 is defining your setup criteria with precision. What exact conditions must exist before you enter a trade? Trend structure, support and resistance, specific confirmations. If it's not clearly defined, it's emotional. Step 4 is defining your trading hours. When are you allowed to trade? Which sessions align with your strategy? When will you stay out completely? Step 5 is defining your review process. How will you journal? What will you track? How often will you analyze performance? Write it, print it, follow it. No negotiation. No, just this once. The moment you negotiate with your rules, you weaken your identity. Elite traders do not rely on willpower every day. They rely on structure that removes the need for constant internal debate. Your rule book becomes your external brain. When emotions rise, the paper does not change. The ink does not bend. That stability protects you from yourself. Another critical step in building elite discipline is starting with smaller capital than your ego prefers. Most traders want to scale quickly. They want meaningful profits immediately. But discipline built under high pressure usually cracks. Trade smaller than you want to. Small enough that losses do not emotionally shake you. Small enough that you can focus purely on execution quality. When money pressure is low, clarity increases. When clarity increases, consistency improves. Elite discipline is built slowly. It is strengthened through repetition. You prove to yourself that you can follow rules at small size before earning the right to increase it. Once discipline is proven, not assumed, but proven through data and journaling, then size can increase gradually. Not doubled overnight, not scaled emotionally after a winning streak. Gradual increases maintain psychological stability. Size without discipline equals destruction. Many traders scale too early, experience a drawdown, panic, and lose months of progress in days. Professionals understand that capital growth must match emotional growth. If your psychology cannot handle larger swings, increasing size will expose weakness instantly. To accelerate this transformation, commit to a 30-day discipline challenge. Not a profit challenge, not a double your account challenge. A discipline challenge. For 30 days, no revenge trading, no increasing risk after losses, no breaking your written plan. Journal every single trade with honesty. Stop trading immediately after hitting your daily loss limit. Follow your checklist before every entry. Respect your defined trading hours. Track your emotional state. Measure rule adherence, not just P&L. For 30 days, your only goal is perfect execution. Some days will be profitable. Some days will not. That is irrelevant. What matters is behavioral consistency. At the end of those 30 days, you will notice something powerful. Your reactions will slow down. Your urge to chase will decrease. Your clarity before entries will improve. You will feel more in control, not of the market, but of yourself. And that shift changes everything. Because the true transformation in trading is not financial at first. It is psychological. Profits become more stable when behavior becomes stable. Emotional spikes reduce, overtrading decreases. Drawdowns become manageable instead of catastrophic. You stop trying to win the day and start trying to execute the plan. That identity shift compounds over time. Elite traders are not special. They are structured. They are not genetically gifted. They are disciplined. They do not possess secret indicators. They possess non-negotiable rules. They do not wake up more motivated than you. They simply refuse to violate their system. They don't chase money. They protect capital. And in trading, capital protection is what creates profit consistency, because when losses are controlled, gains compound. When risk is stable, psychology is stable. When psychology is stable, execution is precise. The market will always test you. There will always be volatility, news spikes, fake breakouts, unexpected reversals. None of that disappears. What changes is how you respond. With a rulebook in place, with fixed risk defined, with daily limits respected, with journaling integrated, with patience practiced, you stop being reactive. You become deliberate. You stop gambling with emotion. You operate with structure. And here is the final truth: success in trading is not about predicting the next move. It is about becoming the kind of person who can survive thousands of moves without losing control. When you build discipline step by step, when you commit to structure over impulse, when you protect capital before chasing profit, you step into the identity of a professional. Not because the market declared you won, but because your behavior did. In the end, the difference between amateurs and elite traders is simple. Amateurs hope, elite traders prepare. Amateurs react, elite traders execute. Amateurs chase outcomes. Elite traders protect process, and over time, the process always wins.